Mhm. Hello, everyone. Today we have the lecture number 3. Uh, okay, this lecture. Um, you remember that in previous lecture, we made a short excursion into finance. We learned the basic key terms, definitions, and now we start a main part of course, and we need to set our main goal. And our goal is to model the financial market. And what does it mean? It means that we would like to model riskless asset, risky asset, and to evaluate a fair price of the derivative. In our case, it will be the option. Okay? Do you understand our main goal? To model the financial market. Okay. So 3 components we have on the financial market. Riskless asset. It is everything about this is clear, and it is exactly on the previous 2 lectures we already learned about this. The next component is risky asset, and in this course we mean the stock price asset. On this slide, you can see the stock price of any company, and I should open Nasdaq site and to show you other company, other price moves, and you see that it's the stock prices is very fluctuated because at any moment it is like a balance between supply and demand. Many scientists, many mathematicians in any times wanted to predict the price of the risky asset, of stocks or of gold or of currency. Yes. But it's very hard task, very hard problem. And stock exchange, it is like a black box on a live organism that input information and output behavior according to rules to be deduced. Yes. So if we are stay, for example, in this point, we don't know if tomorrow the price will go up or it will be continue to go down. Yes, you understand about it. I would like to learn that there are 3 different type of analysis. It is for stock prices. It's fundamental analysis, technical analysis, and quantitative analysis. What are they? Fundamental analysis look as a factor like a company financial health, market condition different. So it is we need to learn all aspect about the business financial company. The technical analysis, it is have 3 basic assumptions, and it's interesting. No, it's exactly for me, it's interesting. First, stock prices reflect everything. So if you know that this stock have a high price, so it reflects everything about all business components, financial health, market condition, about this company. The second assumption, it is that the prices move in trend for long prices, and you see, yes, so for long periods, prices have a trend, and there are other assumptions that the price patterns tend to repeat themselves. So something you see that it's like repeat. It is technical enough. In this course, fundamental and technical analysis are out of this course, and we focus on the quantitative analysis. So it is like mathematical model using statistics. Mhm. Okay, okay. Um, some some history some history. You can have a look on this list, how many scientists, mathematicians, and economists wanted to predict, yes, these stock prices. And you see that almost all of they are Nobel prizes, yes, Nobel prizes. The Bachelier was the first who considered these stock prices like stochastic process, and he assumed that it is a pure stochastic process, and we can't to predict the price. So he considered this stock price like a random walk. And it was exactly his idea to consider option, because okay, I cannot predict stock prices, but what is about derivative, about for example option? Can we compute the probability? Okay, for example, if we stay in this point, we cannot say that, for example, at this what price will be at this point, but we can compute the probability that the price in this point will be more or less than this. It's possible. It's possible using like basic of probability theory. After 65 years, Samuelson rediscovered this work and proposed something new, but it is approximately the same theory. Markowitz and Charpin, they were agree that it's impossible to predict stock price. So they proposed portfolio theory, no, like diversification, yes, diversification your money between different kind of assets of stocks. Merton and Scholes published their formula for fair option pricing. So their work is based on the Bachelier and Samuelson, and it is about using call and put option again. After that was Engel, Fama, and Endelbrot. For example, Fama proposed the efficient market hypothesis, and it was in 1965, but Nobel Prize only in no, recently we can say it, yes, in this year. This his hypothesis, it is like assumption to model to model asset prices, and after that option prices. So more in detail, what states the efficient market hypothesis? First, it is like in technical analysis. Do you remember that the asset prices fully reflect all available information, all available. The second, it is like we hope that the agents have a rational expectation. It means that they would like to have profit, and their action, it is like how to reach this profit. The next, investor reaction will be random and follow a normal distribution. Normal distribution because all about some values. Yes. The next, that the net effect on market prices cannot be reliable exploited to make an abnormal profit. So the mathematical expectation of profit is zero. No, it means that today, for example, you win, but I lost. No, but in general, but in general, the sum of win and sum of lost, it is equals, and in general, mathematical expectation of profit is zero. And in general situation, it is like doesn't matter how what is the way you choose to invest your money. In a derivative or in stocks, or you put your money on the bank account. It's in general, but in the every concrete situation, it different. It matters. So direct implication of this point, it is that impossible to beat the market. So like it's impossible. Okay. Impossible that arbitrage exists. Arbitrage doesn't exist as a trading strategy. And so maybe I need to say, what is the arbitrage? Arbitrage, it is probability of making profit without any risk or loss and without initial capital. So in one place,
excuse me, as far as I know, arbitrage is
trading,
or at least used to be buying something from one local market and selling at another market so that you get the profit from the difference
Yes, but we can state that it is not exist, because if this exists, so it is only a little time. So in general, we state that the arbitrage doesn't exist. No, it is like a assumption. Yes, what is efficient market hypothesis, but real life can be different. Okay. Understand? So our assumption that arbitrage doesn't exist like a trading strategy. And it means that we can do risk neutral probability assignments. I will explain about this later. Okay, so it is a brief overview of option pricing. One period, arbitrage, multi-period, and different replicated strategy about American, after that American option Black-Scholes formula. And very interesting will be the dynamic delta hedging. It is the thing which you can use in your professional activity. Okay, so we start with stock price dynamic in the binomial model. Binomial means that from other point we have only two scenario, up scenario and down scenario, and we need to know the initial price. For example, for this slide, it is $100, and we need to know what is interest rate, and we need to know the rule, how we can compute the price in the up scenario and the down scenario. And you see from this, it is like multiplied, yes, multiplied by 1.07. And after that, again multiplied and again. Okay, and now we would like to focus on the one period model. It is like this one period model. Yes, one period model, and again this U and D. It is as I shown you that it is this value is called 100 multiplied by U, this previous multiplied by U, and this it is previous multiplied by U. But we can express this value 122.5 like 100 multiplied by U at the power 3. Okay. Okay, now we assume that we know this U and this D. Why we know it is like the topics of the next lessons. Now in this lecture we only assume that we know this value, and we consider the probability space. And there are only two outcomes. Only two outcomes. It is price go up or price goes down, and there are two probabilities for this: P and 1 minus P. No, because it's probability. Yes, some should be equals 1. This probability we call like true probability. For example, if we hope or we know that the up scenario may be more have more chance to be. So the probability is more. Yes, for example, this 0.70%, yes, but for the down scenario, our probability, our hope, our chance is 30%. After that, we know the interest rate, and the strike price too. It is given because we would like to model this financial market for this situation. And our financial market, as I said, includes not only risky asset like stocks, but derivatives. Okay, but now before yes, about model of this stock prices. Okay. Now we would like to use the probabilities approach and efficient market hypothesis. So you remember, yes, efficient market hypothesis states that there are
excuse me. I wanted to ask a question about the previous slide. How do we get coefficients for the up price and the down price?
This U and D?
Yes.
It is from statistical history, and exactly how it will be maybe in 4 weeks on our course. But I'm going. Yes, I'm going to tell about this. Okay, so it's very important efficient market hypothesis for today. So according this hypothesis, there are risk neutral measure. So what is this? It is like there are probabilities, but it is not these true probabilities, like hope that it will be. It's other probability, risk neutral probability. What are the probability? What is their sense? It is probability which provides that the mathematical expectation of discounting profit is zero. Yes, so why all this? Because we said that the efficient market hypothesis, it is that the mathematical expectation of profit is zero. There are probabilities that mathematical expectation of profit is zero. So we can write this like this. Yes, mathematical expectation, it is like discounting profit, and it is that according exactly this risk neutral measure, and we don't now this measure. We don't this measure, but it's easy to rewrite this in like the formula 2, because this it is discounting profit means that S0 it is at the end of period. We divide by 1 plus R because it is discounted, minus S0. Yes, this. But if we would like to find the mathematical expectation, so mathematical expectation of this will be, no, I can say this. I'm afraid about time, but okay. Mathematical expectation from this. It is like constant. I can write this before mathematical expectation. Yes, 1 plus R, and mathematical expectation from C1. Mathematical expectation from S, sorry, no CS, from S0, it is constant, so it is like S0. Yes, no, because this minus this equals 0, so mathematical expectation this equal mathematical expectation this. So we have this equation, and from this equation we obtain this equation. Okay, and you see it's a very interesting sense in this. It is like if I use risky asset stocks, yes, S0 it is invest in stocks in initial period, and S1 it is the price of stock at the end of period, and mathematical expectation we don't know, yes, what will be S1 at the end of period, so we can find just mathematical expectation. But it is from left side, yeah, mathematical expectation S1, no, at this point, at point t equals 1. So mathematical expectation and point t equals 1 for stocks equals this, equals like we just invest in your bank account, a 0 multiplied 1 plus R. Okay, so it is what states the efficient market hypothesis. So there are probabilities for this mathematical expectation stock price from stocks, yes, equals like invest in your bank account. Okay, and if you would like to consider the example from a previous slide, it is 100, it's 107, it is 93.46. So now we need to apply not this P because it is true P, but Q. Q, it is risk neutral probability. So mathematical expectation will be 100. What will be mathematical expectation at the point t equals 1 if we have two value, this value with probability q1 and this value, no, or qu maybe up scenario, and this with probability qd. How I can find the mathematical expectation at this moment, please?
107 multiply Q
U
Q2. It's
plus,
mathematical expectation.
it's not,
E plus
yeah,
plus 100.
no, we have only these two values. We would like to
um,
find mathematical expectation at the moment t equals 1.
Ну, so plus 93.46
Yeah,
multiply Q,
D,
I
да,
don't
no,
know,
Q down
QD.
scenario.
Yeah,
And
okay.
according this efficient market hypothesis, it will be the same how if we would invest in bank account. So it would be how much?
It would be 100.
If we invest it at this point, t equals 0, 100. So for this point, it will be how much?
What? How much?
No, how much? If you
Probability?
No. It is like from excursion from previous lecture. You put your money on the bank account, and you know that for this period the interest rate are. So how much will be from this 100? If it is like other situation, you put into account 100. So at the end of the year, it will be how much?
101.
100 multiplied
Multiply by 1 plus r.
1, yes, thank you. Nice. 1 plus r, yes. Yeah, understand what does mean risk neutral probabilities and what sufficient market hypothesis. It is that exist QU and QD, this that the mathematical expectation from stocks, the profit at the moment t equals 0, mathematical expectation equals like we invest in the bank account, but now this t equals 1. Okay. So you see this. No, it is. I can in this like write or as I write on the previous slide. It doesn't matter. It doesn't matter. But if we solve this system, okay. I write again. So this it is the same. It is the same. And if I write that 107 multiplied q, it is like at previous slide. Yes, we just have written plus 93.46 multiplied. It's like qu, but qd it is 1 minus q. Yes. And it is equals 100 multiplied 1 plus r. But r is 1 is 1%, so it is multiplied 1.01. And the second equation is, no, the second, it is, if I like Q1 and Q2, no, so Q1 plus Q2 equals 0. But now it's just one, this. It is just one equation, not system, this equation. So if we now solve this, it is 107 plus 93, minus 93.46 Q, and it is equals this plus plus this 93.46. And solution of this equation, we can check this. Okay, it is okay. Can know this. This, yes. So, and so if we solve this equation, the solution will be Q equals 0.557. 557. Okay. Okay, so it is like this Q and 1 minus Q. So we found the risk neutral measure. Okay. After that, how we can find in this case, the fair price of this call option? I mean that that it is like fair price for premium for call option. You remember, yes? Okay, how we can find? According the definition, fair price for this premium for call option, it is like mathematical expectation of the profit and discounted. So again, fair price is mathematical expectation of the profit and discounted. Profit for call option, it is market price minus strike price. For put option, it is opposite, strike price minus market price. Okay, it is definition. What is, no, but it's natural, yes, natural, because it is like a profit. We have profit, and we just find mathematical expectation because it is random value and discounted this. Yes, it's logical, very logical. So we can continue our example, and we know so we know this risk neutral measure because it's mathematical expectation exactly respect to this measure. We know strike price. So we can find this this function. It is like Payov function, yes, Payov function f equals s minus k with plus. So for up scenario, it is 107 minus k 102. But for down scenario, you remember it was 93, and if we 93 minus 102, it will be not positive, negative value. So in this case, we write 0. I explained what does mean this plus at the up, yes, after bracket. Okay. So the fair price of call option, we need just substitute in this formula 3 1 divided 1 plus this r 0.0. After that, we need to find mathematical expectation from this. 5 from probability Q up and 0 from probability Q down. It is like 1 minus Q. So mathematical expectation from this 5 multiplied Q plus 0 multiplied this 1 minus Q or Q2. And it will be 2.75, no, 757. Okay, so now we know how to one period model we can find the fair price for the premium, for call option or for put option. Is it clear? Maybe you have any question? Maybe you would like again, yes. So we have
What does mean fair price?
fair price. It is like on the site. Okay, maybe now I show you again. We have Nasdaq, yes, this site Nasdaq. 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 We need to choose company. For example, Google. Google. After that, we can see, for example, for 1 year, yes, the stock prices, and you see that it's very fluctuated, and we can't to predict what the price will be tomorrow, yes, and so we think, okay, but what if we use option? So we choose option pricing. We know that today it is the price 252. We can choose that, for example, September 19 and September 19. It's not so good, but November. November, yes. So, so today, for example, 252, and no, for example, in 1 year, but I can 1 year, no, one period, and you see that the price should be from 230. No, for example, we can consider 230. It is for stock price, yes. And in the up scenario, for example, 217 and 217. It's about stock prices. Okay, and yes, this is strike prices. It is strike prices for option. If we would like to deal with call option, it is left. From put option, it is right. If we hope that the price will be more than today, so you need to deal with call option, left. Okay, for example, left. And I need to choose any strike price. For example, I choose 255. No, yeah, 260. 260. 260. It is like what? 260. It is more than today and less than at the end of scenario. Yes, and I see that the premium for this premium 12.12. Okay, you see this? It is like premium on the site. Premium on the site is 12.12. Why this price? Why this price? Maybe there are some algorithm in Nasdaq. Yes, maybe it's balance between demand and how it's called demand and no, okay, you understand? Yes. Попит and пропозиція. Supply and demand. Yes, maybe this. But now our aim to find the fair price, a theoretical price for this C, and to compare with this 12.12. Understand? What is premium? What is fair price?
Yes.
Did you understand? Yes, my answer. Okay, so exactly this. So and you remember that we defined the fair price like mathematical expectation. Yes, mathematical expectation, but not from this, but from Pio function. And what is Pio function? What is Pio function? Or for this example, what is Pio function? Did you understand Pio function? So at the up scenario, what is your profit at the up scenario? If you buy this call option with this strike price, what is your profit at the up scenario?
It's 270 multiply Q1.
No, it is. I asked you to say me what is Pio function. Pio function, it is how much you will have in up scenario and in down scenario.
So 18.
18?
No,
Why 18?
270 minus 252.
No. At this moment,
Shouldn't we
yeah,
count
please.
270 minus
Yes,
260?
exactly. Yeah, exactly. It is because you bought the call option, and in this call option is pointed that the strike price is 260. So at this moment you can get this difference, and it is 10. Yes, it's the up scenario. But what will be at the down scenario?
Minus 12.12?
No.
No, sorry.
Yeah, no. Why? Because call option or put option, European option, it is the derivative which gives right but not obligation. If it's not profitable, why it will be minus? What did you say? Like, or maybe repeat, maybe. Alexandra.
So it will be null.
It will be null. Yes, the Pio function it will be null. Exactly. Because it's not profitable. But net profit, it is like we paid this money, so this with minus. But it's not Pio function. Pio function, it's exactly this. So maybe now it's clear for you how we can find this Pio function. Yes. But now we need to find this theoretical theoretical fair price. Theoretical, it is like discounted mathematical expectation of your function. Yes, so it is it is like 1 divided by 1 plus r, and mathematical expectation, it is 10 multiplied QU plus 0 multiplied QD. No, plus that, then multiply 10 multiplied QU plus 0 multiplied QD. So I write just this, but R, it's not problem to know, but what's QU now we don't know for this example, but maybe you understood this situation, okay? Real situation in real life. No. Maybe I need first to clear, and after that this, and after that we it's not this, it's not this. This, yes, yeah, this. Okay. Okay. Yeah. Do you understand what we would like to compute? We would like to compute the price of this premium, and really this premium we can see on the site, but it is like empirical, yeah, market price. But we would like to compute the fair price. Fair price means theoretical price. Okay, and now you remember that we are mathematicians, and we need to research, to learn, to find out what is about the existence of this risk neutral measure. What is condition for this? Yes. Maybe it's always, maybe that there is some situation, some conditions. So again, we repeat like in example. So the mathematical expectation and the moment, the final moment at the moment till equals 1. Mathematical expectation, it is this value multiplied Q1, and this value multiplied Q2, and it equals like we put your money S on your bank account, and Q1 plus Q2 equals 1. Yeah? Did you understand this system? Have you any question for this system?
No.
No. Okay. And you see that it is system of 2 linear equations, and everything you are able to research, to learn. For example, we use the Cramer method. Do you remember Cramer method? First you see maybe that we can cross this S, yes? Do you remember what is the Cramer method for solving the system of linear equation? It is like determinant
of
Yeah.
x. So
It
like
is- Uh-huh.
the first row
Uh-huh.
is determinant for x1.
Uh-huh.
I remember it's something with determinants, but I don't
Okay.
really remember the first.
If Q1 it's like x1, Q2 like x2, so what I need to write down in the first row? No, for example, 5x1 plus 3x2 equals 7. And the next equation 2x1 minus 4x2 equals 1. What is determinant for this system?
5 multiply 4 and
Mm.
minus 2 multiply 3.
Yes. So I can write this like 5 and 3. It is like first row, yes, and 2 and minus 4 at the second row, yes, and this it is like a determinant or determination of this second order. It is like this multiplied to this minus this multiplied to this. Yes, it is with plus, it is with minus. Yeah. Remember this. Okay.
Yes.
So for this system, what I need to write like determinant?
UD
UD. Okay, thank you. And this,
1 1.
and this one 1 1, and it should be like
U
please.
minus D.
U minus D, yes, U minus D. Okay, but U more than D because it is like up scenario. So it is always more than 0, okay? Okay. Okay, if you would like to solve this equation, we need to compute some delta, no, x1 delta x2. For this example, what it should be? Delta 1.
7.
Yeah, 7 and 1. No, 7 and 1, yes.
Yeah.
And
3 minus 4.
and 3 and minus 4 remains, yes. Okay, in our example, delta 1, it should be
R plus 1.
okay, r plus 1 and
1.
and 1. And this the same, the second column the same, and it should be 1 plus r, 1 plus r minus d, yes. Okay, and delta 2, just for my example, for this example, it should be
U1 and 1 plus
U1.
R.
Okay, and U1 and 1 plus 1 plus R and 1, yes? And it will be 1 plus R minus U. 1 plus R minus U, Okay, so how I can find Q1 in this case according Cramer rule? It is like what is the rule? How to find x1, for example, this? Do you remember? No? Okay, delta 1 divided by delta, and Q2, delta 2 divided by delta. So delta 1, it is 1 plus R minus U, 1 plus R minus U, and delta,
Delta 1 is 1 plus R minus D.
delta 1, oh, thank you.
And I think we are not correct in delta 2. It should be like U minus 1 minus R.
Oh, you're right. You're right. And U minus, yes, 1 plus R. 1 plus R. You're right. And it means that you're listening to me. Super. So in this case, Q1, it's probability, yes. And like any probability, it is not negative, yes. U minus D, we know that it is positive value and yeah, U more than D. So in this case, we can write that this value will be positive 2. Positive 2. No, maybe equals 2. And for Q2, if we write the same, it will be delta 2 divided by delta the same. And for this, we need to write that it is more than 0, 2. So 1 plus r minus d more than 0, and 1 plus r more than less than u. Yes, you see. So I obtained the condition about 1 plus r, that it is more than d and less than u. Do you agree? Okay, so it is our condition. So you see, it is all this delta 1 divided by delta 2 divided by delta, and so we need to write that 1 plus r more than d and less than u. Okay, so it is like theorem, the necessary and sufficient condition for the existence of the risk neutral measure is the condition 8. And if the risk neutral measure is unique, then the market is complete, because can be that this condition exists, but risk neutral measure isn't unique. It is when the delta 1 equals delta, yeah, you remember 0 divided by 0. Okay, so that's all about the first way, the first method, how we can compute the fair price of this premium by probabilities method. Okay, and there are the second method, and it's called pricing by the absence of arbitrage. Okay. I think that I understand that I have only 5 minutes, but maybe you allow me to finish, and after that we will make our break. Okay? Do you allow?
Okay.
Oh, okay. So it's not so long like probabilistic method. Okay. Repeat, what is arbitrage? Arbitrage is a condition to get a positive profit without initial capital and without risk. Okay. For example, arbitrage is a situation where you can simultaneously buy and sell the same or similar product or asset at different prices, resulting in a risk-free profit. No, but okay. So consider the situation at the initial moment at the t equals 0 that you remember that it's without initial capital. We don't have initial capital, so we to borrow at the bank and buy X shares with price 100, and we buy Y derivatives, no, exactly call option with premium C. So initial amount is, yes, 100x, because X it's how much and its price. Y it's how much, call option, and its price. Okay, so all this at the moment t equals 0. What happens at the t equals 1? You remember that we have no this example. So there is two scenario. at the initial moment the price 100, but this it should be or 107 at the up scenario, or 93.46 at the down scenario. And okay, so at the moment T1 we have X shares. So from shares we have 107 multiplied X profit, your profit, yes, your profit. And what is about option? Option the derivatives with what is price for derivative? Do you remember? K equals 102. 102. So for this moment, what is your function for call option?
107 minus 102.
Yes, it's 5. It's 5.
Yeah.
So yes, at this moment, we have 107 multiplied x and 5 multiplied y. This it's like payoff function, yes, because it is like agreement. But for stocks, you have the full price because and you paid for full price 100, yes. So at this amount you have in your pocket at this moment, but you need to repay this initial price, yes. You need to repay in your bank with percent. Okay, understand this? So at the moment t equals 1, in your pocket in up scenario just this amount. But for the down scenario, in this if we this point equals 1 and down scenario, so stock price, from stock price you have 93.46 and multiplied how much we have these stocks. But for from option you don't see you don't see possibility to realize it's not profitable, yes. So your profit zero multiplied y, and you need to repay to the bank account this sum. Okay. Okay, so you see that and we would like that it should be without risk. Without risk means that the profit in up scenario equals the profit in down scenario. What without the risk means doesn't depend on the scenario. So this row equals this row. It is the same. It's like crossed. So we have that this equals this. Yes. But it's equation from two variables, so we can solve this. We can only express y through x. Yes. Okay. Interesting. What will be now? Okay. After that, we apply the second condition, the arbitrage. There exists if we have a positive profit for any scenario, not zero, yes, positive profit without risk and without initial capital. So for example, we take this first equation, yes, first equation, and we would like to find when this equation more than zero. No, this we can open the bracket, yes, simplify, and it will be this, and it follows that we would like to find from what C, it will be more than zero, or less than zero, but the absence of arbitrage, it is like equals zero, only equals zero, it is absence of arbitrage. But if the arbitrage exists, one side can have positive profit, or another side has have positive profit, but this negative profit. And if we solve this equation, we obtain that the fair price is 2.757. And you see that it means from the probabilistic way. And it is like a miracle, okay? Miracle of pricing by the absence of arbitrage. And that's all for today. That's all for today. Today we learned two ways for finding this fair price. We took the one period model, and we considered the probabilistic way and the pricing by the absence of arbitrage. Okay? So it is like stop, and we can